Good morning, good afternoon, and good evening, folks, depending on whatever time frame or time zones you guys are based in. I'm based in London, so good afternoon for myself. If you guys can hear me well and you can see my screen, please do give me a sound and a screen check by saying yes or no, so that I know that you guys can hear me, and more importantly, you can see my screen. It should say AvaTrade's Masterclass, How to Trade the US NFP. So once again, if you guys can hear me and you can see my screen, please do give a sound check and a screen check by just typing yes or no. I haven't got any feedback yet, so I'm presuming that you guys still cannot hear me. Oh, there you go. Okay, thank you so much for everyone for replying. And thank you, Walter, thank you, Martin, and Jazim, if I am pronouncing the name correctly. Right, it's always a pleasure to have all of you here. In today's webinar or master series, we'll be looking at the US non-farm payroll data, which is coming out on Friday in 2 days' time. Very, very important number, why it is so important, how it is going to influence the markets, which instruments are likely to see massive momentum on the back of that, and where are the trading opportunities. That would be the part of this particular webinar. We will go through the full agenda and some study questions later on, very, very briefly, in fact. But before we do that, a bit about myself. My name is Naeem Hassan. I work as a chief analyst for AvaTrade. I come with an experience of 15 years of trading experience. During this time period, I worked as a hedge fund trader for Bank of New York Mellon, as an equity trader with Bank of America. Many of you may have seen me as a regular guest on CNBC, Bloomberg, and several other TV media outlets. Now, here are the social media handles for you guys for AvaTrade, for Telegram, for Twitter, and YouTube. The recording of this particular webinar will be available on YouTube. So if any of you who doesn't really understand anything, you can always go back to our YouTube channel and you could see that recording again. Something that I wanted to go through with you is about the AvaTrade's unique technology. Really, really good technology called AvaProtect. It's a revolutionary one-click risk management tool available on the AvaTrade Web Trader and AvaTrade Go app. With AvaProtect, you can purchase protection against loss for a defined period after opening a position. If the protection ends and you have an open position that is losing, AvaTrade will reimburse the loss directly into the trading account. The only cost is, of course, the AvaProtect fee itself. Here are the risk warnings and disclaimers. Nothing can be perceived as an advice. As always, if you are seeking for one, please do consider consulting with your own financial advisors. Now, are you guys ready for an excitement for this particular webinar? So if you are, do download the platform in your own time after we finish this one, so that you guys can really get advantage of that. So here are some of the important study questions. Now, in order for me to gauge the caliber for all the participants in this particular webinar, I'm going to ask some of the basic study questions. So I would expect you guys to participate in that. And as always, you are more than welcome to ask me any questions as we go along. Remember, there are no right or wrong questions. Every question is a right question and is an opportunity for you to learn. So take this opportunity while you have it to ask me any question that you have related to markets. I'd be more than happy to answer them. Now, here is the first one. For those of you who have attended, excuse me, any of these particular webinars before, please get your fingers running and answer the very first question and describe what is a US non-farm payroll data. Yeah, the answers are coming. I want everyone in this room to answer the first question, whether you know it or whether you don't. If you don't know it, just say it that you don't know. I won't be calling any names, but I wanted to know how many people in this room actually know what is US non-farm payroll, what it stands for, NFP, why is it important? Okay, that's really good to know that there are a few people in this room who actually do not understand what is US non-farm payroll data. So the US non-farm payroll data comes on every Friday, every first Friday of every month, 99% of the time. It gives us the information about the US labor market, how strong or how weak the US labor market is. Why it is so important for investors and traders to know about the health of the US non-farm payroll data is because the US central bank, which is called the Federal Reserve Bank, watches the economic activity very, very closely. Their monetary policy, i.e. their printing of money, or whether they are going to have a hawkish or a dovish monetary policy stance, is very much dependent how the markets will perform, how the markets, how the economic activity is. If it is strong, then they adopt a hawkish stance. If it is weak, then they adopt a dovish stance. There's a very, very important one. So that is the connection between that. So let me write that down over here for you guys to really understand. If the eco data, or what we call it economic data, is powerful or is coming up better, the Federal Reserve on the other side, which is the central bank in the United States, if the economic data is good, then the Federal Reserve becomes what? It becomes hawkish. So they have more aggressive monetary policy. They will have no longer loose monetary policy in the market. However, if the economic data begins to deteriorate, begins to show weakness, the Federal Reserve over here will have a dovish monetary policy, meaning they will have more accommodating monetary policy by printing more money, by lowering the interest rate, and so on and so forth. Now, right now, the Federal Reserve over here, it has a very hawkish monetary policy. They are increasing the interest rate, they are reducing the support in the market because for one particular reason. They want to control inflation. And in order for them to control inflation, they are trying to increase the interest rate aggressively. But they cannot continue to do this particular thing forever because they have to pay attention to the economic data over here. So far, economic data is holding what it is this arrow is telling, meaning it is telling us strength in the market. But now it is primarily believed that the economic data could begin to show us some weakness in the weeks ahead. So this particular number, which is going to be coming out this particular Friday, when the number will come out, we will look at that, all of that, and the way to find them in just in a bit. But if it shows weakness, the Federal Reserve over here, who has a hawkish monetary policy stance, or who's increasing the interest rate, if this number becomes a lot more weaker, then the Federal Reserve cannot have this one over here whatsoever. The Federal Reserve would have to shift from hawkish to slightly bit more dovish monetary policy. Does that make sense? Because I want you guys to be absolutely clear about this particular one before we continue any forward. So once again, the US non-farm payroll data, it comes on Friday, the very first Friday of every month. It comes at 1:30 p.m. London time or 12:30 p.m. GMT. Okay, you can see that on Forex Factory. You can see the data on AvaTrade's website as well, or any other economic number. We will see that just in a bit. The US non-farm payroll data is very, very important because the Federal Reserve over here base their monetary policy based on that. What is the connection between them? The connection is if the economic data becomes strong, the Federal Reserve has a hawkish monetary policy stance. If the economic data begins to show weakness, the Federal Reserve has a dovish monetary policy stance. Currently, the Federal Reserve has a hawkish monetary policy stance, meaning they are increasing the interest rate. However, if the economic data, the US non-farm payroll data, shows weakness on Friday, then the Federal Reserve cannot continue to increase its interest rate at the current pace, which is 75 basis points. That is what the Federal Reserve increased its interest rate last time. Now, the expectations are that the Federal Reserve will increase the interest rate by 50 basis points. But if the economic data shows strength rather than weakness, we could see the Federal Reserve increasing the interest rate by 75 basis points. Otherwise, 50 basis points will be very much done deal. If the economic data shows weakness, 50 would be very much in question. We could see the Federal Reserve increasing the interest rate by only 25 basis points. But for that to happen, for this to happen, the Fed economic data needs to show enormous amount of weakness. So with these ones, we got the first three important points all covered for you guys, because these are the most important points for us to really pay attention to. Now, the next one, which is where to find the economic data. Now, in order for you to find the economic data, what you could do is you could go on to forexfactory.com, and over there you can have a calendar. So on the calendar, what we have is we go on to click on more, and then it's going to load the calendar. It's going to show you the economic data, and then you will see that on Friday, right over here, 1:30 p.m., this is the number which is expected. The unemployment rate is expected to remain same. Now, if unemployment goes higher, the Federal Reserve cannot have a hawkish monetary policy stance at the current rate. If the unemployment, the US non-farm payroll employment change, if this misses the forecast, right, we see less employment in the market, then that shows weakness in the employment market. That means the Federal Reserve cannot continue with its current pace of interest rate hike, which sits at 75 basis points. So then the Federal Reserve will have to shift towards 50 or even 25. So these two numbers coming on this particular Friday, they are very, very, very important. Sorry, three numbers. Even the average hourly number is also quite an important one. So we got to pay attention to these numbers coming on Friday when this data will be released. Any questions in relation to that? Because if you have any question, this is the time for you guys to ask me those questions, because remember, there is no such thing as right or wrong questions. Every question is a right question, okay? Now, let's go on to the next one. We understand the basics, the foundation, the fundamentals of the economic data and the importance of that. Now, the next part which comes is that what instruments to trade on the back of this particular data. Now, the instruments that you can trade on the back of this data, can anyone give me or help me that what instruments can we trade? What can you trade on the back of this particular number? Eurodollar, yeah, absolutely right, Albert. Albert, you're talking absolutely right. Anyone else? So Forex is one of them. So anything which is against the dollar, whether it's a euro dollar, whether it's a sterling dollar, whether it is dollar yen, anything which is against the dollar is going to see pretty significant moves on Friday at 1:30 p.m. London time if the data misses the expectations by a significant margin, or if the data comes very strong with respect to the expectations on Friday. So you could trade Forex. The second is Walter is saying that you could trade commodities such as gold. Absolutely correct and right on the money. You can also trade not only Forex, but you can all trade commodities as well. Let's write them down over here for everyone to understand that. So we can trade FX on the back of this particular data. We can trade commodities such as gold, on the back of this particular data, and we can trade what else? Can someone else tell me? Martin is saying that you can trade stock indices such as S&P 500 index, which is absolutely correct on the back of this particular data. So S&P 500 index, the Dow Jones Industrial Average, the NASDAQ, in fact, you could also trade the European indices on the back of that as well. So the importance of this data is so huge that it not only it moves the US stock indices, but it also has massive influences on European indices as well. What are your European indices? Can anyone give me one particular European index? Okay, I got something over here which I need to read. Someone has written a very long comment, so let me just read that. Can you please explain why the market, especially the indices or the stocks, are acting positively regardless of any negative news? For example, high inflation, fear of recession, negative GDP data, economic slowdown, but with all these stocks are still shooting up. Can you please explain why the market, especially the indices or stocks, are acting positively regardless of any negative news? For example, high inflation. Okay, so it's just the same. Can you please explain why the market is especially? Okay, so I think you've written the same question about 2-3 times. Yeah, okay. Thank you for the question, first of all, and I will explain that. So Martin has said the European indices is DAX. Absolutely correct. So you can trade DAX, you can trade CAC, you can trade stock 600, stock 50, any of them as well on the back of that. Now, God's power is saying, what instrument can someone trade on Friday? God's power, so what we're really discussing over here, for Forex, okay, Eurodollar, sterling dollar, anything against that, gold, any commodity, S&P 500 index, US Dow Jones Industrial, DAX, all the stock indices you can trade. Now, the question earlier asked by, let me just see who asked that question, by Walter, I believe, was the question, why markets are going higher. So the markets are going higher because traders and investors believe that inflation has reached its peak level. Now, if that is true, that inflation has reached its peak level, then that means that the Federal Reserve is going to have an easy monetary policy. They're going to reduce the pace of the interest rate hikes, and that is positive for the stock market. That is the reason that we are seeing more improvement in the stock market. Now, if the Federal Reserve is going to reduce the pace of its interest rate hikes, that also reduces the fear of recession. The Federal Reserve has already, the US has already changed the definition of recession. They do not believe that the US is in recession. However, in Europe, we do have a recession with the economic readings, GDP dropping consecutively. So we are not completely out of the woods, but there is optimism among investors and traders who believe that, okay, there is a strong possibility that now we could potentially be moving to the upside, and that is what is really influencing the stock markets over here. I hope I answered your question. Now let's move on to the more important aspect of this particular session, and that, because we covered the first question, we covered the second question, we covered the third question, we covered the fourth one. Now the current state of markets and analysis on that. That is what we're going to cover now. So what I'm going to do now is I'm going to bring out my MT4 platform, and we're going to go through that by looking at the different stock indices and everything within that. But before we do that, let me get rid of all the writings over here. And thank you so much for everyone to ask so many questions, because it is very, very important for you guys to ask questions. And there's you know, it's really, really imperative. Now, remember, earlier we talked about that we can trade gold on the back of the US non-farm payroll data coming this particular Friday. Can everyone see my screen back again, right? Everything is all good? Yes or no? You should be able to see my MT4 screen now. Thank you, Martin. Thanks, Sandra. Thanks. Thanks, Nolene, everyone. Thanks. All right. Okay. So this is gold. This is a daily time frame for gold. Now what we need to do is we need to define our support and resistance levels ahead of this particular data. Now on Friday, if there is a disappointment in terms of the US non-farm payroll data, if we see a weaker number coming, right, gold is very, very different. It can bounce higher, it can move up, bounce up on the back of the weaker data, or it could also move down as well, because gold is considered as a safe haven asset. If the data is really, really weak, we could see investors and traders coming into the market and thinking, oh God, okay, we need to buy protection, and gold will provide that protection. If the data is very, very weak, traders will think that the Federal Reserve is not going to increase the interest rate. The dollar would fall. When the dollar falls, usually gold prices goes up. Okay, so that is the scenario number two. If the data is really good, we could see the dollar index moving to the upside, because the Federal Reserve would increase the interest rate, as we mentioned earlier, more aggressively perhaps. Gold prices could fall. If the data is really good, the Federal Reserve would increase the interest rate. The markets would potentially increase, because they will think that, okay, economic activity is still holding up. The Federal Reserve can increase the interest rate. There will be more demand for riskier asset, and gold prices can fall. So those are the four scenarios that we're going to keep in mind. If you wanted to hear them again, the recording of this one will be available on YouTube. Have a look at that. So in terms of my support zone, what I'm really focused on is two zones. The first one runs from 1708 to 1780. The other one runs from 1671 to 1692. In terms of my resistance, I'm looking at 1796 to 1830. Right now, the prices are in battle with the 50-day simple moving average. This is your 100, that is your 200-day simple moving average. Now, watch the price. If it crosses above the 50-day simple moving average, that would be your signal for the prices to continue to move higher. You could keep your stop losses below the 50-day simple moving average. If the price breaks below the 50-day simple moving average and stays below that, that would be your signal that the bull run is no longer intact. This particular rally that we have seen in terms of the price action over here is no longer going to continue to the upside. in fact, we're going to see a momentum to the downside, right? So I'm going to repeat that. When the price breaks above the 50-day simple moving average and it stays above that, keep your stop losses below the 50-day simple moving average. Let the market continue its direction to the upside, okay? Then the next resistance is going to be right over here, around the 1957 and 1909 price levels, okay? These are the resistance levels over here. If it fails and doesn't move above the 50-day simple moving average, we're going to see a momentum to the downside, and we're going to see the prices coming into these particular price levels. That is for your gold. Now, let's move on to the next one, and that is your S&P 500 index. Because remember, we talked about the S&P 500 index is also likely to move on the back of this particular one. We have already discussed if the data is good, we could see the S&P 500 index moving to the upside because traders will think that despite the hawkish monetary policy, the economic activity is good, so this is positive for the stock market. This is for those of you who think the fear of recession and everything else, right? If the data is bad, or let's say if the data is good, but the stock market falls, that can happen as well. And that would be on the basis of the expectation that the Federal Reserve is going to continue to increase the interest rate more aggressively, and the fear of recession will really prevail. And then we will see the stock markets retracing. The other scenario is if the data is weak, investors will think that the Federal Reserve can no longer continue its aggressive stance. So we will see a movement to the upside. If the data is weak, the stock market could still fall because they will think the recession is here. The Federal Reserve has jeopardized everything. Now, what are the price levels that we've got to pay attention to? So for me, it's really the fair support zone in terms of the price action going to be coming over here. The most important price point to pay attention to is the 100-day simple moving average over here. If we stay above this one, you can place your stop losses above that and then continue to move higher. The resistance is going to be 200-day simple moving average or that 4,200 price level. After that, the next resistance is going to be 4,500 sort of a price level. If the price breaks below the 100-day simple moving average, we are moving lower and we are going to be visiting this particular price level. However, there could be another support zone just near the 50-day simple moving average, near around that 39.31 support level, and we could potentially see the prices moving back from here to the upside. But wait for the price to break above the 100-day simple moving average for the final confirmation that the recession fear or the downward trend is very much clear. And we are in the clear, and the markets are going to be likely to move to the upside. Now, the next one is going to be the Eurodollar. Over here, the path of the least resistance in terms of the price action remains skewed to the downside. This remains your vital price point. I believe that the prices, only if they move above the 50-day simple moving average, then we have a case to move to the upside. The resistance is right here near 1.0398 sort of a price level, right over here, or 1.04 sort of a price level. The indication is going to be coming when the prices will move above the 50-day simple moving average. If they don't, then we are likely to move to right into this particular support zone. All right, folks, that's the whole time that we have for today. And remember, as always, the recording of this one will be available on our website. So feel free to go over there and have a look at it. I will see you guys next time, same place, same time. Until then, stay safe, and thank you for attending.